It is cost concept. As per this concept, any asset that we purchase should be recorded on its cost. On its cost plus any cost of acquisition, repairs, etc. at the time of purchase. That is, let's say we purchased a particular machinery for rupees 10 lakh. Machinery cost is rupees 10 lakhs and transportation cost is rupees 50,000. So as per this concept, the machinery would be recorded in the books at a cost of rupees 10 lakh 50,000 and this price would not change. So now when the machine appears at 10 lakh 50,000, it would continue to appear in the balance sheet at the same value, and over a period of time whatever depreciation is there on this value would be reduced. This concept has a major limitation also. What is a major limitation? The limitation is that it fails to represent true and fair picture of accounts. Now students, let us understand by taking an example. In 1980, a business purchased a building in CP area of Delhi for rupees 40 lakhs. Now as per cost concept, this building would appear in the books at rupees 40 lakh. Rather, whatever depreciation would have been there should have been reduced. Now, today's market price exceeds, let's say, 50 crore rupees. But as per accounting concept of cost, this 50 crore rupees price is not being reflected. So, market price is 50 crores. But we are showing it at 40 lakhs. So this concept fails to represent a fair picture of financial position. It is a very major limitation of cost concept.